Hey, everybody. So, Warren Buffett is stepping down as CEO of Berkshire Hathaway, and that kind of has renewed a lot of interest in investors to try to find the next Berkshire Hathaway. Now, to be clear, I don't necessarily think there will be another Berkshire Hathaway to that extent anytime soon, at least not in my lifetime. Um, but you never know. There are some companies that do have some early stage Berkshire characteristics. We're going to dive into a company that I think is a great early stage Berkshire Hathaway comparable, and Tyler does as well. Before we dive in, we are please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, if you haven't figured it out, the stock I am talking about is Markel. Ticker symbol is MKL. For the longest time, it's kind of been considered an earlier stage Berkshire Hathaway, and for really good reason. The business has a lot of parallels to what Warren Buffett does. At the last Berkshire Hathaway meeting, I was actually sitting next to Tom Gaynor, the CEO of Markel. Well, he was sitting down the row. He was sitting next to the Motley Fool's Bill Mann, who's more interesting to talk to than me. So a lot of parallels there. They're an insurance company at heart. They own a big stock portfolio. Markel's number one holding, it used to be, I'm pretty sure it still is Berkshire Hathaway. It used to be Berkshire Hathaway. I think that's still the case.
I believe it's Visa now. I would have to
Okay.
double check, but
Berkshire's
at
still up
the
there though.
one of the most recent meetings that they did, Visa, Deere, and Hope Depot are three of its like big core positions.
Yeah, and those used to be up there. It used to be Berkshire was number one. Like I said, I'd have to look, but it's still up there. But very similar investment styles. You mentioned Visa. Visa is a holding of Berkshire Hathaway. A lot of overlap in their stock portfolios. Markel invests in wholly owned businesses and things like that, but can do it at the scale that Warren Buffett wishes he could. Buffett's made comments like, "Give me $1 million to invest, and I'll double it this year," because at smaller scales, it's easier to do that. I don't know about this year, but it's easier to compound money when you have less of it than when you have hundreds of billions of dollars. Um, so Markel has a lot in common with an early stage Berkshire Hathaway, and the business is, you could argue, is kind of trading at a pretty good discount right now. Just a couple of statistics from after their fourth quarter earnings report, and I'll kick it to Tyler in just a second. After their fourth quarter earnings report, they announced a big review of the business, and they mentioned that they feel that the stock is undervalued right now. And just looking at the statistic, over the past 5 years, Markel's stock price has grown at an annualized rate of 9%. Not a terrible rate of return. Historically, that's close to being in line with the S&P. But over the past 5 years, Markel's intrinsic value or book value has grown at an 18% annualized rate. So the growth of the business has not been reflected in the stock. That's obviously frustrating to management. So it implies that the stock has some pretty significant upside, just based on what they've already done, not necessarily the success of the business going forward. So Tyler, I know you're a big Markel fan. You just had as you said, brunch is not the best term anymore, but you were just at the Markel brunch in Omaha, which is the same weekend as the Berkshire meeting. So what did you learn there, and what are your thoughts on Markel as a business right now?
Well, it's funny we call it like the new Berkshire Hathaway, but actually, I think technically as a business, Markel's older than Berkshire Hathaway. I think it was started in like the 1930s or something like that. It is a specialty insurance company at its core, with this operating portfolio. It's publicly traded company. For all the companies that claim to be like the next Berkshire Hathaway or try to do the best impersonation of Berkshire Hathaway, it seems to me Markel actually does the better version of it, for the simple fact that, like, if you look at its corporate structure, it doesn't take performance fees or anything like that, where all of its management has a decent stake in the business, and it uses that as a way of compensating its management team, versus some of these other ones, like a Bill Ackman run, where they're going to do a assets under management and a performance fee on top of it. You can't be a Berkshire Hathaway and structure yourself in that way, because the amount of just the simple fact that taking returns off the table for our investors is very un-Berkshire like. And so in that sense, like on a corporate structure, Markel is the closest thing you're going to find, at least in that regard. Um, as far as the business goes, yeah, it's on evaluation, it actually looks pretty cheap these days, pretty attractive. The company always runs a really conservative model, always running a heck of a lot more cash than debt on the books, a lot of redundancy, and it's an insurance business because it is in unique specialty insurance. A lot of things that other companies don't do. It's not like Berkshire in the sense of it has like Geico or things like that. It's like marine shipping and energy and a lot of things that a lot of people don't typically underwrite. And the nice thing is when you do that, you can typically be profitable because you're one of the only people fishing in those waters. At the same time, um, it's hard to price because the risk models are way different, right? There aren't like these common actuarial tables for marine shipping or wind turbines versus, I don't know, auto insurance actuarial tables and risk profiles are pretty well known at this point. And so because of that, they run a pretty conservative portfolio in terms of cash, debt, whatever. um, the one like you said, the stock price has kind of been fledgling despite the book value actually increasing quite a bit. It's got a decent stock portfolio that nobody follows like the Berkshire Hathaway portfolio, but a portfolio of quality companies that they seem to buy at decent rates. Its operating portfolio is considerably smaller as well, but it has other quality businesses like building products distributors and things like that. Not anything that anyone's gonna write home about. But then again, does anybody really talk about like John Mansville or Clayton Holmes at Berkshire Hathaway either? So you can kind of squint hard enough, you can see the assimiles between Markel and Berkshire Hathaway. I to be honest, despite this restructuring and the undervaluing and the buybacks, it, it looks like a good business right now. The one thing that has been noticeably weak over the past few years is its insurance business has not been as profitable. Combined ratio in the most recent year was like 94%, which is pretty high if you compare it to a lot of other specialty insurance companies these days. And so, with that in mind, it kind of to me, it kind of looks like an opportunistic time in this kind of business because you're buying it at one of its weakest times in insurance. Its operating portfolio seems fine. Its stock performance portfolio seems fine, but you're getting a pretty cheap business on weak insurance. And if the restructuring that they say is, it's a little bit like back of the house, we're going to kind of simplify insurance and use some like shared resources a little bit better. If that actually pans out and they can improve its combined ratio, then we could see some pretty good results in the coming years from Markel for a business that right now trades at like 13 times or 14 times earnings. It's a heck of a lot cheaper than you can get Berkshire Hathaway these days. You're muted.
Another specialty insurer that I follow is Kinsale Capital. Just to put some numbers in perspective, you mentioned the roughly 94% combined ratio. Kinsale is the only pure play specialty insurer in the market and generally runs like about an 80% combined ratio. So a big difference there. Kinsale does not trade at 13, 14 times earnings. I can tell you that much. Um, Markel believes that the management team believes the intrinsic value of its stock is roughly $2,600. They said this in their fourth quarter earnings report, which is roughly 30% upside from where it is right now. The investment portfolio returns have been strong. That's arguably been the strongest part of the business. 5-year investment portfolio annualized returns of about 14%. So pretty impressive growth there. There's a lot to like here. The insurance business has been kind of a tricky one over the past like 5 years. Um, Essentially, whenever you have inflationary periods, insurance takes a little while to catch up. For one, premiums are usually paid in advance. So if I pay an insurance premium now and inflation is 9% over the next year, the replacement cost of everything the insurance company is going to have to pay is going to be 9% greater, even though I paid the premium at the uninflated value. And a lot of regulatory, you know, rules prevent insurers from raising premiums, so like without approval. So it's usually kind of after the fact that they'll make like a reactionary adjustment for inflation or increased costs and things like that. So it takes a little during inflationary periods. You generally see, higher combined ratios. It takes a little while for things to catch up, and some of that is definitely happening here as well. Markel is one of the larger investments in my portfolio. I don't think it's quite in my top 10, but it's close. Um, and I mean, it's a very expensive stock on a per share basis. I remember when I first started at the Motley Fool, it was like a $600 stock, and I thought that was crazy expensive. So it's a fun one to watch. Really interesting business. I would love to see their shares be $700,000 one day, like Berkshire Hathaway's are. But I'll settle for a nice market beating return over time. Tyler, thanks for a great discussion. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.